So one of the biggest things today, potentially, could be the FOMC minutes. I'm still setting up the screen, so that's why you don't see anything yet. It takes a moment to go over to YouTube and do all the gremlin stuff on the backside. But with the FOMC minutes today, there's a possibility that the market might reconsider this exuberant push that we've been getting since the CPI, PPI, FOMC event that started all of this not very long ago, right? A couple weeks. That's where this flip came, right? When everything changed back here and we rallied up. Now we have an FOMC in December, and consensus says at some point the market is going to wake up to the idea that they're off, that they're wrong, right? At some point. So to kind of get a little bit of a grip on what's been happening after FOMC and CPI, PPI, the market had a couple of really big firms, Goldman Sachs, JP Morgan, a couple others, say, oh, the Fed's going to cut next year, probably in July, June, heck, maybe even in May, and added to the job numbers that we got as well. The market really just jumped on that. We're gonna start seeing cuts, early to mid next year, and that's what they've been pricing in. So if you go to the Fed Watch tool, this is December. The pause is 100% priced in, so no rate hike, but no cut. Take it to January, same thing, no rate hike, no cut. But in March, we have a little bit of a cut beginning to show up. And in May, it's the dominant thing. It's what is priced in right now. And this is what they've been pricing in, this unwind of higher for longer. That's what's been helping fuel this rally to the upside. But the Fed really didn't change anything in their message. Their message was, we're going to hold and we're going to watch the data. They didn't say anything about cutting. The markets just read into it and said, oh, well, it really looks like we're going to be cutting by middle of next year. And that's what they're pricing in. You get into June, and the two dominant ones is that we'll either have that 25 basis point rate cut, or they'll be actually down to a 50 basis point cut, right? From our 525 down to a 475 by June. This is unrealistic expectations. And by July, that we will have that 50 basis points by then. So they've been unwinding that higher for longer, and it's been fueling this exuberant push to the upside. When we get the minutes today, the market may get a little bit of a culture shock, a wake-up call, a reminder that the Fed's message hasn't changed. It's been the same message for over a year now, that they don't want to be known in history as the Fed officials who had all of this inflation come in and they tried to get it under control and then let it go too soon and seen inflation rear back up, and they have to double down and push even harder to knock it down. They don't want that in there. attached to their name. And I think that pride, as oddly as it sounds, is more threatening to them than the outcome of all of this inflation and rate hikes and rate cuts and everything else. They just don't want it attached to their name as being the goofball that screwed it all up. So we do have the threat today that the minutes might reshake the market's foundational core and get them to reevaluate this exuberant drive that we've had. So we're mostly flat, down a little bit in Europe, which makes sense. We got Christine Lagarde over there getting ready to chip teeth. Everything else is either down about 0.25% or less, which means it's not even hitting our benchmark of 0.5% yet. It sure looks like a hurry up and wait situation here, and that kind of makes sense, right? We've got enough on deck right now that hurry up and wait makes perfect sense. So we can see existing home sales, and that by itself is generally a pretty big deal. But then we also have the minutes coming out at 2 o'clock, and we have data coming out of Canada and Europe today. So, globally, we've got a lot of really big data going on. And we've got the 10-year. It's not as fabulous and fantastic as the 20, but this one has a lot of weight behind it. This one's a really big deal as well. So if you like what happened yesterday at 1 o'clock when that volatility and volume came in and we had that really nice drive, now it doesn't have to be up or down, right? It's this isn't calling for a direction, just volatility. Because remember, volatility is just the nerd word for movement. Yeah, I'm a nerd. Lots of big stuff going on today. Right now, it's going to be really important to watch the dollar today. So while I'm talking about the dollar, we'll just have these spot gamma levels here. I'm going to go through them as I talk so you can catch your screenshots. So the dollar is below that 105, 104 and a half, and it's getting into a critical area where it very likely could find support. Now we're still looking for the top to be in for the dollar. So any discussions of the Dixie rallying, right, is the dollar index. Any discussions about a rally is just talking about a rally into resistance, because markets shouldn't just move in a straight line. We don't want it to just fall all the way down or run all the way up. We want that trending classic price action that moves to the downside, pulls back to a 786, breaks level and moves down to the next level, right? That's what we want to see. Well, we're at that point where the dollar should bounce. It's a pretty strong level. And if we get that rally in the dollar today, we're going to get sync between the dollar and the 10-year, right? Because we got the 10-year rising up this morning. It's above VWAP. It's trying to come up off that bottom. Yesterday, things really started to sink between the 10-year and the dollar, both to the downside, and we had these beautiful moves in the NASDAQ and the S&P to the upside. So that's the threat here today, right? If the dollar finds support and starts to run, then we also have the 10-year rising, then we've got them both working together, and that could really whack the S&P and the NASDAQ to the downside. Tech is already leading us lower. NASDAQ is down much farther below its VWAP than the ES is, and it's expanding lower or trying to. So a rising dollar, if this 103.2 does happen to be the support that I think it is, that's significant support. We're talking, a 2, maybe even a 3-day run that could get us back up into 104. It's not enough, right? It's not enough to shut down this magnificent trend that we've been seeing in the broader markets. But with FOMC data today, with everything else that's going on, and a rising 10-year, that could shut this trend down that we've been seeing and stall us out, or worse, drop us down. Remember, the dollar isn't our influence for higher and lower. We're not looking at the dollar and thinking that it will push our markets down. But a falling dollar gives the S&P the slack or the room that it needs to rise. And a rising dollar is going to be a weight around its neck, holding it back and making it difficult to rise. That's really a much better way to perceive the dollar right now. We got tangled up in the call wall yesterday, or at least the call wall's a new location, because this is the now data. I've already updated the gamma indicator. Eight 30, 10, 11, 11:30, 1 o'clock, 2 o'clock. It is a full house. It is also a short week, and there's a good rule of thumb that says that a short week is generally difficult. I mean, look at yesterday's price. It was just fantastic, right? But it was explosives, very violent moves. But generally speaking, there's a lower volume during a shortened holiday week, and lower volumes is where price can really move fast. Newer traders tend to forget that dynamic, or just don't quite grasp the logic of it. But lower volume is where price can really move fast, because there's just no one at that next level. Right? If you think about the bid and the ask, and traders reaching up or traders reaching down to get their trade filled, if there's nobody there, then you have to reach even higher to get it filled. Right? You're trying to find a seller, and the seller is sitting farther away. The only thing that moves price is traders that reach. So now we're underneath the call wall. The call wall generally is viewed as a significant resistance level, because it's generally where there's a lot of selling. They'll monetize those calls. If they are long, then they're selling them to close. There's just a ton of sellers sitting at that level. So, it's not impossible to get through there. But until they roll that wall up, it's difficult to see how we could sustain a move through there, that we're likely going to drop back down again. So for us to get through that call wall today and really drive higher than yesterday's high, we're going to need some really good data. We have an MDP right now. That's a missed daily pivot. So just like it sounds, we haven't hit the daily pivot point yet. That makes it an MDP. There's a strategy that goes with it. I don't trade the strategy, but I absolutely love it for analysis. It's not mine to teach, but if you were to go to YouTube and search for missed daily pivots, you would find, I think it's Rob Knox. I think it's him. Either way, you'll find the creator, and he's got some videos on what it is and how you can use it in your analysis, even if you never trade with it. Either way, having a missed daily pivot form today will be useful to us tomorrow, not today. But so far, it is an MDP. The volume is a little light, but at least we know why, or we think we know why. We think we understand why the volumes are a little light. The reason I look at this every morning is because there are quieter times before COVID, before, these rising rates and runaway inflation and everything just went nuts. There was times where you'd log in, you get, settled in to the computer, and the volume would just be really light, and there wouldn't be any reason behind it. No, nothing that you could point to and say, what's going on here? What's wrong? And unless you knew what light looked like, then you really didn't have a way to quantify that. So I started using this overnight volume, and it's cumulative volume. So every new bar that prints, that volume, if it's positive volume, gets added to all these. And if it's negative volume, then it gets subtracted from all these. And it's just adding more and more of this volume together. On this one, I don't even think it subtracts any volume. I think any volume, positive or negative, just gets added and added and added to this one, to this cumulative volume. And after looking at this for a couple of years, because I've run the same charts now for years, you kind of get a feel for what normal looks like. 80 to 180, that's a good average normal. Above 180, there's something wrong. There's heavy trading, and we need to know why. And below 80, there's something wrong. There's really light trading, and we need to know why. Well, we pretty much have established the markets on this hurry up and wait mode. We're looking for FOMC minutes. We've got Christine Lagarde and a couple of other really big data points coming out today, and the market is cautiously waiting on that data, and it's a short week. So we're already expecting lower volume because of that. So seeing the low volume today, hey, okay, we think we got it under control. If we didn't know any of that and we just saw this low volume, we'd want to call timeout right there and start hunting around for why is the volume so light. That's why I look at it, is to get an idea of where the volume is at today. And if I don't know why, then I want to know. Think of it this way. Before we came to the charts and we were still looking at all the news, and I had already mentioned it was supposed to be a light day, a hurry up and wait day. What if we'd have got to Thinkorswim and that thing had been sitting at around 200 instead of 78? Really heavy cumulative volume on a day when we shouldn't have that kind of volume. It would certainly get our attention. We'd have to figure out, hey, what's wrong here? This isn't what we thought it was going to be. Where's the heavy trading coming from? So, it's more of just a check. And if it's where it should be, then we're done with it. 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. And when we're at the highs, we expect to go to the lows. Get tired of hearing that after a while, I bet. Liquidity resides on the other side of the pivot. Probably get tired of that one too. But they're fundamental pieces to trading effectively. We've extended ourselves beyond the point of control. It looks like we hit that top and rejected from it, but in reality, we made that top and then we pulled back, and now that top exists. It wasn't the top until we made it so. So we didn't hit this profile's edge and pull away from it. We still don't have a classic pattern here, but if we were to, give a classic pattern to this, I would say most likely still a B. We still need to get through the entire week before we lose all of this volume down here. That's a lot of data that we have to lose. Now, this one in blue is called TPO, time, price, opportunity. And while it looks just like a volume profile, it's not a volume profile. think of it as volume by time, where the one in green is volume by price. The one in blue tells us that we've spent the most amount of time right there over the last 10 days. That makes sense because that's also where we have the most volume now. What would be surprising to us would be, say, if we ended up with the point of control here. If we got a ton of volume right there and we spent almost no time there at all. That's why we use these together instead of individually. Either way, really nothing much to see here. Just like with cumulative volume, there either is something here that is pertinent and valuable and relevant, or there's not. And that makes it really simple because stop by, take a peek. Nothing's here. Move on to the next one. So yesterday I carried forward that point of control. Was pretty sure we were done with it, but I wanted it there in case we pulled back again to that area. We never did pull back again to that area, but we can take it off the table because it was not a VPOC that we want to keep. We have a new VPOC given to us from yesterday. $45, $46, $75. Might as well call it $45, $47. So we're getting a nice little collection of VPOC levels underneath us. Kind of broaden this out for a moment. You see what we're working with. Eventually, we'll likely go down and hit those old levels someday. And if not, well, whatever. I do have to say, though, at some point when we change contracts in the ES, I find those levels less relevant. Because if we're marking them on the understanding of unfinished business, then once we've rolled contracts, say we leave the December contracts and we start using March, well, there's no December unfinished business left, right? And so they kind of lose their relevance at that point. That's not something that's really covered in the books. You know, in the textbooks, when it comes to volume profile, they don't really discuss things that expire. But I feel that it's really important considering we're looking at futures, you know, and they're just not relevant anymore. And I've seen enough examples by now of old levels that belonged to a contract that we no longer have, and we run right through them like they were never there at all. There is not even a change in volume structure when we cut through those levels again. So I've kind of come to the, you know, realization that old VPOC levels from contracts that are no longer with us are worthless. But that's one of the things we get from doing this over and over and over again, right? Is we get to see useful bits of information. We do have divergence right now between the point of control within our Globex price action and the point of control within the TPO. We've spent the most amount of time up here. We can see that in blue. But we've collected the most amount of volume down here. And we can see that in the point of control. Now, the interesting question to that is, when did the big amount of volume happen? Here? Or later on as we kept coming back through that level again and again? If we were using a TPO chart, something that Thinkorswim calls monkey bars, we could probably see it. Or, you know, the footprint charts is another phrase for that. We could also use volume bars. They look just like candles, but their shape or their thickness is derived by their volume. So we could use that and try to figure out when this volume came in. And then, of course, there's always something simple like just turning regular volume on and seeing if there's a big bar there. Sometimes we don't have to get, like down in the weeds, nerdy. We can just do something really basic, like turn volume on. But as you can see, with the really light volume that we've got going on here, by itself, it doesn't seem like it would be enough to bring that point of control down to that level. 45.55 exactly, not just, oh, well, we picked up volume along the way, right? That's why footprint charts and TPO and monkey bars really kind of add that relevance of when did that volume come in. Because it looks like we hit an iceberg, but it could have been a flip point. Now, with shortened weeks, these weekly expected moves are a little janky. Now, one thing to keep in mind, when we measured last week's range and we compared it to this week's range, I mentioned that morning that the market needed to close first before we would really want to evaluate the new week. Because throughout the trading day on Friday, the size of that box could change. Notice that the size of the box is barely just a little bit smaller than the week that we had last week. The box that I drew is barely sticking out of the top. The thing is, we're 1 day less this week. So this box should be much smaller. It should be missing a fifth of the entire range. Because it's not a 5-day range now, it's just a 4-day range. And yet there's so much volatility priced into this week that the box is nearly identical to last week's. 2 points lighter? That don't seem like much. So there's a big threat. This is why I continue to say that selling short-dated options is very dangerous right now, and you probably shouldn't do it. The phrase here is not my phrase, but I love it. The juice ain't worth the squeeze. Right? The risk is just not worth the reward. And you would have to get so far away from the market to hope to not get run over. And the craziest thing is, no matter how far away you get, the market can reach you anyways. Because in a high volatility environment, the market can easily make a 2, a 3, or even a 4 standard deviation move. If you ever want to be able to measure a standard deviation and you don't want to get into the hijinks of the math behind it, trying to figure it all out for yourself, you don't have to. Thinkorswim will draw a standard deviation for you using the right now optionality of the market. Just go to the Analyze tab. Everything in this gray area is set to probability as default. So you can just go up and hit reset on your analysis tab. You can then look at the week you want. Friday optionality actually expires the next day, so it's common to see Saturday lit up. So you can go in there. You can choose Friday or you can choose Saturday, either one. Then hit what they call the hamburger here, the show actions menu. Set slices to 2 standard deviation. That's what that sideways little A is. There's your 2 SD right there. And what it's going to do is move these gold lines to 2 SD. You can also hit this drop down here and you can visually see a 2 SD. Notice the probability range for a 2 SD. It's got a 95.45% chance of closing within this range. That's what that probability says. So we've got a little more than a 5.5% chance that price closes outside of that gray box at the end of the week. A 5% chance that we close outside the box. I mean, that sounds great, right? A 95% chance that we're going to stay in the box. But in a high volatility environment, we are in that 5%. That's what the risk is. So I mentioned that Thinkorswim would draw these for you. Well, we don't really need price. We just need the range. So I deleted that price slice, which is what it's called, those gold lines. And now I want those gold lines on my chart. So we go back to the Show Actions menu, and we set slices to the chart. And right there, I've got a 2 standard deviation range drawn on my chart. Now, the thing is, if you want to keep them and you want Thinkorswim to draw other lines, you need to change their name. If you don't change their name and you try to draw other lines with Thinkorswim, it will remove these and it will put the new ones on there for you. But now that I renamed them, they won't leave. So now if I want that 1 standard SD, and you don't have to change the gray box, I just do it to keep the visual intact. There's a 1 SD. We've got a 32.5% chance that we'll close down here versus up here. But when we add those two together, we get a 68.27% that will close inside this box. And we can put those lines minus the right now price. We could put those lines on the chart the same way we did with the other lines. And there's our SD1. It's 1 standard deviation. Now, this is different than the Friday's range, right? The one from Friday locked into place and it never moved again. We call that a static data point. It's locked in time, it's frozen. This is a dynamic data point. This data is constantly fluctuating and changing. Right now, between now and Friday at the end of the day, this is our current 1 standard deviation range and 2 standard deviation range. Yes, we could go all the way up to 46.78 by the end of the week, and it still wouldn't be considered an outsized move from our current location. But there's a 95% chance that we won't close above that level by the end of the week. And there's a 95% chance that we won't close below 44.50. So maybe that'll save you a little bit of math. Don't try to calculate it for yourself. Just let the broker do all the work. We had to learn all of that in my math classes in psychology. Obviously not how to use Thinkorswim, but how to get SD. So KWeb is giving a lot of it back from yesterday, down over 1%. Bitcoin down 1%. China itself down, and then lower than our benchmark. We've got things like tech and energy, but it's not down enough to meet our requirements. On the upside, we've got gold miners, and that's it. Really, we don't even have miners because it's not up enough. We just have gold. GDX is a miner. I think so. I think GDX is a miner. Yeah. Okay. So we got miners. So this is the important part right now. It would be the dollar in connection with the 10-year and anything that's coming out of Europe and Canada. See, the dollar dropped and treasuries rose. If that dynamic changes, that's the threat, right? If the dollar finds support and begins to rally with treasuries, game on to the downside. And I had already warned of this, and we're already seeing the fall, right? So it's not much of a shock. But here's the key. According to analysts, the minutes from the FOMC meeting will give insight into why the committee's policy statement and Fed Chair Powell's remarks were somewhat dovish, despite solid economic indicators leading up to that gathering. They're looking for the minutes to explain the behavior that they've seen out of the Fed. And so we got to play out two scenarios here. One, and this is usually what I lean towards, is that the minutes or the data that we're looking for is going to be muddy, that it won't be clear cut. I know that's what everybody wants to see. Something very clear, very organized and distinct that says, if A, then B. But a lot of times the data is like muddy water. It's a little bit of this and a little bit of that, and there's not enough to really plant both feet. If we get muddy water today, then we're going to have to continue to lean on all the other drivers and try to figure out what next. Are they going to continue this unwind at sitting at 5.25% and start and continue to price in rate cuts, which is going to continue to drive us higher? Or are they going to get a wake-up call and start repricing in higher for longer? That's the thing today. So don't get all bowed up and get ready to short this market. Because if it's muddy water data and we don't get enough information, then the market can just stall out here, not fall and not rise. And we'd be looking for some other data point, something big. And that'll be the next driver. It's a nice continuation in this move to the downside. But notice we're getting this move to the downside in the ES and most especially in the NASDAQ. But we're not really getting much out of the 10-year, and we're not really getting much out of the dollar. And those are both going to open here any minute. But where's the move coming from if it's not coming from the dollar and the 10-year? All right. So jets are down, semiconductors, crude, Bitcoin, and China ADRs. To the upside, silver, gold, gold miners. Can't trust that one. It says US technology ETF, but those are just little notches. There's no flows behind it, and that isn't what we want to see, right? So we just kind of look askance at those and just discount those. But we're not seeing any sneaky ones like EV or pot stocks or small caps rally. None of that. There's no hidden message behind it, right? There's nothing there. Usually on a day like this, if we're starting to see a little bit of a rotation, we'll see those pot stocks or solar names, the EVs, something, biotech, but we've got nothing here. So other than precious metals that are moving as US dollar Japan maintains this low, other than that, we don't have anything moving to the upside. So here's the fangs, not all of them, but most of them. We could add, AMD and Snow, but I don't. NVIDIA's got earnings tonight. They continue to say that their revenue could be better if they could put more stuff out the door, which, that makes more sense, right? Just like Pepsi or Coke or any of those others. If we could make more product, we could make more money. But with Pepsi and Coke and all those, that's not exactly true, right? They got warehouses full of stuff. They just need to sell it. NVIDIA is saying we can't get it out the door fast enough. If we could just make more, then we would make more money. Now, if they can present that during their earnings announcement in a positive way, and they are working on trying to increase how much they can produce, then they're going to continue to go up. They're talking about, exponential growth. So the only way I see that they're going to have a bad earnings is if they somehow drop the ball on their forward guidance going forward. We can already look at what they've done. It's easy to look at what a company did, over the last quarter. That's not in question. It's what are you going to do next that usually trips a market up. So that's why you can't go in with really high conviction for an earnings trade. You just don't know what that forward guidance is going to look like. Now, if you have something like Earnings Whisperer and Market Smith, those two combined can generally give you a pretty good idea of how their earnings is going to go. So if you are wanting to be an earnings kind of trader, there are tools that exist for that, but they're not cheap. I don't tend to use them because I don't play the earnings gamble guess, right? I'd rather play the run into earnings and then after the report, play the other side of earnings. That's more my jam. And I don't have to spend a couple $100 in a month on tools to do that. If NVIDIA has a good earnings, we're talking about, $650 and $700 in its share price. But if they screw this up, we're looking easily at $400 for NVIDIA as a starting point. Netflix came out of that IX10 with a really nice example of why we even pay attention to an IX10 setup, just because of that outcome right there. PayPal has extended its IX10 for another day. Remember, the longer that we stay in this range, the greater the outcome is going to be, the bigger the move. The problem is there's no direction to that. Tesla also building up an IX10. Remember that it's important for the IX10 to be behind a small candle. If you're hiding inside of a really large bar, like we have here on Microsoft, well, that's not gonna work, right? It's not building up compressed energy if it has all this room to move. We need to find things that are compressed within a very narrow range, like Amazon is starting to do right now. We've got inside day, not IX10 yet, because we've only got 2 bars. But that is a really tight candle. And so far, we're still inside it. By tomorrow, this time, if we're still sitting inside this range, we'll be IX10. And that's an exciting IX10 because we're talking about serious compression there. And it's at the top of the zone with surge. Well, we had surge. We dropped underneath that white line. So we're no longer in full surge. But we're primed and ready, right? That would be a white line crossover, a 3MA cross, and a breakout after IX10 if we get one more day. Couple of ways we can measure this. We could take the entire zone and plot that up. We can take this newest leg and we can plot that up. We can take the current last big bar and we can plot that up. We can take yesterday's price and we can plot that up. Now you start to get a lot of stuff set up there, right? So just kind of clean it up a little bit. There's our upside levels. Now those are intraday trace levels, right? Those are just really fast, giddy up kind of moves. And all of those measurements can be done in the other direction, at least for these last two, to where we could have, the 50% and the 100% measures in the other direction. When Amazon comes out of this box, it's likely to make a pretty good sized move. The longer we're in the box, the bigger the move is projected to be. You can kind of pick up on that logic if you apply the RSI Laguerre to that, right? Because that was the first indicator that we ever had that measured energy. That's an odd word in the trading world. Normally you hear momentum, trend, inertia. You don't normally hear energy. And the way that it was developed, we actually learned a lot about a market and how it can gain energy, different things that it can do. One of the things that it can do, to gain energy really fast is to actually pull back in the other direction. So if it had been running to the upside really fast and then it pulls back sharply, that pullback is gaining energy. It's what it's doing. It's like recharging its batteries before it makes the next leg. So again, energy is just an odd word. But that RSI Laguerre taught us a lot about different market mechanics. All right, there's our dollar drop. There's our 10-year drop. We're starting to see a little bit of the reciprocation from that. A little bit, not enough, not very much, not yet, but it's a start. We want to see the dollar break this current low and get definitively below the 103. We want that dollar in the 102 zone. We want the 10-year at the very least to break this Globex low and continue that expansion to the downside. Let's get it below that 4.35. That's a big reach for the day. That's a big ask. But if we get the dollar below 103 and we get the 10-year below 4.3, I think we could easily see a market rally today in the S&P and the NASDAQ. But just to keep some perspective in place, the NASDAQ is only down 0.3%. That's nothing. And the ES is down less than 0.25%. And that's nothing. We're not down on the day. We're barely down on the day. A negligible amount. So keep your eye on the dollar and the 10-year. We're still looking for that dollar to find support and rally. If it finds support and rallies and the 10-year rallies, we're going to continue this fall in the S&P and in the NASDAQ. With US dollar Japan falling, we still got gold and silver to the upside, so we at least have that as a day trade too. And silver's kind of cheap. You know, it could be done with shares and with options because it's not an overly expensive thing to trade. It's reasonably decent liquidity. And for a day trade, I mean, that it's not too bad. Nice approach to it. During TrendSpider's webinar last week, they talked about very soon there's going to be chart trading integrated on their platform, including the ability to trade with your Tradeovate account, which is fantastic. It's not out to the public yet, but in the webinar, they said it was really close to being released to the public. And that's going to be pretty awesome. I've never really used TrendSpider in day trading analysis, but I was checking it out yesterday, just kind of watching its ability to handle day trade analysis, and I was impressed. It was pointing levels out to me that I wasn't catching on my own, which, you know, you can set it to different trend analysis. You can do, you know, original, enhanced, standard. You can even set up your own custom kind of trend analysis. But still, I was impressed. Definitely. There was, it was interesting to see how there would be multiple levels of resistance, and we would run into it yesterday, and solid rejection off of those levels. You know, it was like a lot of this yesterday when we hit that one and fell back away from it, and that one too. Yeah, there was some really good ones yesterday. So yeah, if you're looking to add something, I don't think they have anything for Black Friday. They were doing a big event last week, but yeah, they've got all kinds of changes to their platform. I've been using them for a couple of years. They are always innovating, coming out with new stuff. Now they've got AI integrated into it to help you build scanners and back testers, which is fantastic. I asked him in that webinar, can you use the AI to read your results, right? Because you can do seasonality on this platform. And I said, well, what if you do a seasonality chart like Johnson & Johnson, and it gives you your 52 weeks? Can you then ask the AI to review those 52 weeks and tell you when the best time to buy would be based on seasonality, or when the best time to sell would be based on seasonality? And no, you can't. But his answer wasn't no, you can't. His answer was not yet. I love that answer. These guys are always coming up with changes to their platform. Really good stuff. I don't get anything, I'm not affiliated with them. I'm not talking them up because I'm trying to get you guys to click a link. They're just really good. And when I was new to trading, one thing that I doubted in myself was the ability to effectively draw trend lines and analyze the market with my drawings. That self-doubt can be crippling. But when you draw your own levels and you're checking what they have against what you have, and you realize that you're right, well, kind of eliminates that self-doubt, doesn't it? Do they now? That is cool. So I just seen in the chat that they are promoting now a Black Friday sales event. They didn't have one the last I looked, but thank you for that, because that's good to know. So they do have a Black Friday event going on, and it wouldn't hurt if you did go and Google them on YouTube. If you check TrendSpider on YouTube, they've got a ton of videos on how to use their product. But during this last webinar, they were showing off how I think he randomly chose like the 115 period moving average. He was just trying to walk through the steps of how to perform a back test and then zero it in to really get some actionable data out of it. And it's impressive. So especially for people who can't code, because you can use the AI to speak in plain English, and it'll convert your plain English into the code for the backtest. So, I mean, what's not to love about that? I can code my own stuff, so that's not an issue. But if you can't, well, there you go. And then knowing that they're going to be getting Tradeovate trading right on this platform, oh yeah, I'm excited. I like it. Anyways, guys, I'm out of here. Be careful, be safe. Watch the clock today. It's all about treasuries, and the market doesn't owe us anything. Right? Look at that weekly. It doesn't owe us anything from this level, and we're not overbought enough to owe us a move back in the other direction. So linear regression, least squared methods, mean reversion, none of that is on the table at the moment. I'll see y'all tomorrow.